So we're going to look at Walmart and we're going to try to figure out what the intrinsic value of the stock price is. And the way we do that is we estimate the future free cash flow and we discount that back to today's dollars. So let's get started. Their market cap is $352.3 billion. And their stock price is 124.33. So that means they have 2.8 billion shares outstanding. So when we calculate the future free cash flow, we have to divide it by 2.8 billion to get the stock price. Now let's look at their financials, because that's how we figure out the worth of any company, is through their financials. And cash flow is a good indicator of success, because it's kind of like if you had a business, you would want to know how much cash flow is available after operating your business each year. And some people, like me for instance, have a small business and I just use my net income at the end of the year. That's how much money I make, whatever's left over. And you can't really do that in a business like Walmart or most large businesses, because they use accrual accounting as opposed to cash accounting. So the net income isn't actually money they get. A lot of it could be accounting and depreciation things going on, but the free cash flow is the actual cash that's being left over after each business year. So you can see they have a healthy free cash flow, 20 billion, 18 billion, 17 billion, and 14 billion. So it does drop each year, but it's still a pretty good number. And the net income seems to be all over the place. In 2016, it's 13 billion, then it drops, then it jumps back up again. But revenue is always the smoothest. As you can see, it's pretty consistently growing, because you can't really do much manipulation with revenue. When net income you can, and cash flow is always tends to be a little lumpy because of large expenditures in certain years. Although at Walmart, they probably don't have too much large expenses as opposed to something like Boeing. Now let's look at the capital structure so we know what to discount the cash flows by. So we already calculated the free cash flow. Now we just want to figure out the discount rate. And every company has their own discount rate, because every company borrows money at a different rate. So the current debt of Walmart is $6 billion, and that's debt due within the year. And the non-current debt due beyond 1 year, the long-term debt, that's $43 billion. So they pay 5.23%. That's higher than I would have thought, but that's what it is. That's what it is. Now let's see the effective tax rate. So the income before tax and the income tax. So the effective tax rate is 24%. So even though they pay 5.23% on the debt, we have to reduce it by the tax rate. So the cost of debt is closer to 4%. And let's see the cost of equity. And the cost of equity, we use a CAPM, capital asset pricing model. Wow, that's the lowest beta I've ever seen. That's a really low volatile stock. So they have a really low cost of equity, 4.78%. So their blended cost of equity and cost of debt, the blended rate is called the WACC, weighted average cost of capital, and that's 4.68%. So that's what we have to discount the future free cash flows by, because that's how much money it costs Walmart to get money. So So we calculated the future free cash flow for 4 years, and then we did a terminal value, and we used the Gordon growth model for the terminal value. This is a pretty standard approach. And then we get a value of $1 trillion for the company when you present value the cash flows. So, and when you divide that by the shares outstanding, it's an implied share price of $355, even though it's trading at 124. And this is the chart the past few years of the stock price. So it's trading at a pretty nice discount, a 65% discount. And that just shows you their massive cash flows each year. It's such a strong company, and it's trading at such a solid discount. So this is a definite buy according to the model. Of course, you can't look at the past, you have to look at the future as well. Now, what do you think the future of Walmart will be? I think it'll be pretty good, especially during coronavirus. Sales are strong, probably stronger than ever, but that's for you to decide. And thanks for watching the video, and let me know if you want me to do other videos.